Ladies and gentlemen, a very warm welcome to all the esteemed participants who joined today for the insightful webinar on international taxation. On the behalf of the International Taxation Committee of I, CA Mohit Jain, feel privileged to be part of your moderator for today's session. We are delighted to see such an enthusiastic response for today's topic, safe harbor rules. These are opportunities or limitations, a subject that is both technically and significantly and highly relevant in today's evolving global tax landscape. Today's star from the galaxy are special guest Shri Rajesh Kumar Bhuth sir, a senior IRS officer from the batch of 1994, currently serving as a principal commissioner of income tax APA2 in Delhi. Welcome, sir. Chairman of Income Tax Committee CA Satish Ji Gupta sir, and Vishnu Kumar Agarwal sir, CA, distinguished chartered accountant as a CCM, currently serving as the chairman and peer review board and also the vice chairman of this International Taxation Committee of ICI. Over the next 2 years, we aim to explore not just only to the technical framework of safe harbor rules, but also critically examine whether they are truly serve as an opportunity for the taxpayer or act as a limitation in practical scenarios. Before we begin, a quick housekeeping points are participants are requested to post their queries in the question and answer box. We will take up all the selected and question during the question answer session towards the end only. Kindly ensure your audio remains muted throughout the session. Thank you. Now, to formally commence today's session, it is my honor to invite CA Vishnu Kumar Agarwal ji, the Vice Chairman of International Taxation Committee of ICI, to deliver the opening remarks. Sir, with the vast experience of insights, the field of taxation, we look forward your guidance to set the tone of today's deliberation. Over to you, sir.
Thank you, Mohitji. Respected CA Rajesh Kumar Bhuthji, the Principal Commissioner of Income Tax, 1994 batch. Sir, thank you very much for joining this and accepting the keynote speaker for the larger our own chartered accountant for benefit of our each and every member, sir. So my bottom of my heart, I thanks to Sri Rajesh Kumar Bhuthji for giving his valuable time to our own Institute of the Chartered Accountant of India. This reflects his own heart that I'm attached with the Institute of Chartered Accountant of India first and then Indian Revenue Service. Our today's speaker, Jaya Kumar Tejwani ji, moderator Mohit Jain ji, and our chairman of the International Tax Committee, C.A. Satish Gupta ji. I also thanks to Jaya Kumar Tejwani ji for joining us today in the most important topic, safe harbor rules and limitation and the opportunities for the chartered accountant. Before I just speak about the International Tax Committee, friends, jointly with the Direct Tax Committee and International Tax Committee, we came out with the Income Tax Act 2025 for our chartered accountant, along with the rules in only 1200 of the rupees. Last year, we have came out with only the Income Tax Act 2025 with the 500 rupees. Then very good response has came from across the country. My each and every member of the institute has purchased the Income Tax Act 2025 last year, and all the government organization has also appreciated that the institute has first time came out with the Income Tax Act. Friends, in the same modality, this year also we have came out with the Income Tax Act 2025 in only 1200 rupees of the Income Tax Act along with the rules. So I request my each and every member to buy from our cell counter with 1200 rupees each with the courier charges, including the courier charges. Friends, the second most importantly, because the April month has already going on, and from this year, if any chartered accountant is signing the tax audit report, And if he is a partner in any chartered accountant firm, partnership firm, he can sign individually only tax 60 tax audit report. If he is a partner in any partnership firm and there are three partner in that particular firm, friends, each and every partner will sign 60 tax audit report, and individually he will sign only 60 tax audit report. Before 1/4/2026, it was the rule that any chartered accountant can sign on behalf of another chartered accountant partner any of the chartered tax audit report. Friends, from this particular year, only the one partner can sign only 60 tax audit report. So this is the last year council decision, and from it is applicable from 1/4/2026. Again, the in balance sheet, profit and loss account in the new financial format, friends, it is now from this year it is the mandatory. So my request to each and every my friends and the colleague that this particular year you prepare the each and every financial in the new format. Friends, so many taken decision we are taking from the International Tax Committee. Today I will not speak more because our Rajesh Kumar Putji and Satish Gupta ji, our chairman, is here. Friends, only I think one or two points about the this particular topic. Friends, at at a basic level, safe harbor rules allows taxpayer to adopt prescribed margin and condition which, if followed, are accepted by the tax authorities without detailed scrutiny. This helps in the saving time, efforts, cost for both taxpayer and the administrative. However, at the same time, these rules may not always reflect actual business condition and may not be suitable for every taxpayer and the transaction. But today's my speaker, Jay Kumar Tejwani ji, will speak on this particular topic. But friends, if we practice in the transfer pricing and the international taxation, these all the basic rules must be we follow and known. Friends, with these words, I thanks to Satish Gupta ji because we are organizing every week one particular webinar. Last year, Satish Gupta ji was chairman of mine in the CP committee, and this particular year he is a chairman in the International Tax Committee. Again, this year I am vice chairman of the International Tax Committee. So both the year we have done so many program webinar for the benefit of my each and every members. And once again, I thanks to Rajesh Kumar Budji, Principal Commissioner of Income Tax, for accepting our invitation and joining us for this particular program. Thank you very much, sir.
Recording in progress.
Thank you very much, sir. Thank you very much for insightful opening remarks. Getting in- Okay, now it's okay. Your perspective truly sets the context for meaningful discussion ahead, sir. Thank you very much. Now, it gives a great pleasure for me to invite CA Satish Kumar Gupta ji, Chairman of International Taxation Committee of ICAI, to deliver the address. Before inviting sir, I just want to read a brief profile about the sir. It's like a showing torch to the sun, but just a formality. Satish Kumar Gupta sir is the chairman of International Taxation Committee of ICAI. In addition, he
Okay, Mohit. Okay. Thank you, Mohit. Thanks a lot. I am struggling with the connection,
No,
connectivity, so
no.
don't know more introduction. So thank you very much. And honorable and most respectful my brother Rajesh Kumar Bhutji, honorable principal CIT, Advanced Pricing Agreement, New Delhi. As sir, at the very outset, I would like to place my hearty gratitude towards you for sparing your valuable time. And welcome to International Tax Committee. I'm sorry, sir, we are not even offering you or not able to offer you a cup of coffee here because we are virtual, sir. So sorry for the same. And my learned speaker of the day, C. Jay Kumar Tejwani ji, my brother in the Central Council, very learned vice chairman of this committee and expert of income tax litigation, Vishnu Agrawal ji from Mumbai. Brother Mohit Jain from Kishangarh, a small town but very promising town, very promising chartered accountant, and team International Tax Committee, team Tech Tax, and my dear friends who in a very large number. Sir, Rajesh sir, more than 750 members have joined this webinar throughout the country, and it's really a very big thing. And I know that it is because of your presence. So the people know that since you are there, so it may be something very value additive after hearing you, sir. So welcome to each one of you again, sir. And I just want to say that at our committee this year, we are focusing on the quality and making available the program of the International Tax Committee throughout the country. We are trying to hold several new certificate courses covering various countries like UK, Malaysia, Singapore, South Africa. As of now, we have three courses, sir. One, the post-qualification diploma in international taxation. Another is the US direct tax course, certificate course. And another is the UAE corporate tax course, sir. And we are thinking to bring UK, Singapore, Malaysia, and South Africa. Moreover, sir, we are going to revise our publications, which are very important publication. As informed by the Kapil Gupta team member, that more than 931 participants have joined as of now, sir. It is just an information, but it's really wonderful and good news that members are loving and accepting our webinars. Thank you very much, sir. And Rajesh, sir, I would request only one thing, sir. There are certain issues where the members face some problem, like in Form 41 as of now, we have sent the representation to the International Tax Committee also, that has been allowed to file only once in a year. But due to difference in the year format of various countries, it is very difficult to file that compliance only if it is being done only once in a year. So kindly look on this issue and if possible, to help the members, sir. And thank you very much for your coming. And safe harbor rules, whether opportunity or limitation is the topic of the day. I believe that yes, opportunity is definitely there because there is a certainty and reduced litigation, and both are very big pillar of any tax system. So it is a big opportunity for the trade industry, but limitations are also there because prescribed margins for safe harbor rules are sometimes very conservative and sometimes even higher than the market rates. So it makes a topic very interesting, whether it is for the benefit of the industry or trade or the profession, or there are some challenges which should be met out. In conclusion, sir, I would like to place again my thanks to you and the members of the Vishnubai or Mohit for attending this webinar. Thanks a lot, sir. See you again, Rajesh sir, and see you again, my dear friend, who are looking the webinar in very, very big number. Thank you. Thanks a lot. Over to Mohit.
Thank you very much, sir, for your
Mohit.
Thank you very much, sir, for your inspiring words and for emphasizing the importance of continuous learning in the dynamic field of international taxation. Without taking much of your time, it's time to welcome our special guest, Rajesh Kumar Booth, sir, the PCIT, a senior IRS from the batch of 1994, and he is currently serving as PCIT in APA 2 Delhi. He is also a renowned fellow member of ICAI with the extensive experience in the working tax policy division and foreign taxation division of the CBDT. He has also worked across various verticals of income tax department, including the investigation, assessment, international taxation, appeals, and administration. At present, he leads the APA teams where he is primarily responsible involving negotiating and finalizing unilateral APAs agreement that help provide tax certainty to multinational enterprises on transfer pricing matters. So without taking much of your time, is the time to get the address from the star Rajesh Kumar Booth sir to kindly address the gathering and share his valuable insight with us. I welcome to you, sir. It's all over to you.
Thank you. Thank you. So it is indeed an honor to address the fellow CA members. So CA Satish Kumar Gupta ji, Chairman International Taxation Committee. Sri Vishnu Kumar Agarwal ji, Vice Chairman International Taxation Committee. And Sri Mohit Jain ji, and Sri Jayakumar Tejwani ji, and dear participants, good afternoon. So, as regards the safe harbor rules, let me give you some little bit background. So, because at the time when these rules were framed, I was working in the tax policy division. So, as we all know that with the globalization, the multinational groups started their economic activities in India, and with these, the transfer pricing disputes have started increasing, especially after 2001 when the transfer pricing guidelines were introduced and comprehensive transfer pricing provisions were introduced. So, Finance Number 2 Act in 2009 introduced the first time the concept of safe harbor in the Income Tax Act, and Section 92 CB was inserted in the Income Tax Act. Safe harbor, as we all know, that safe harbor is basically a maritime concept, that where the ships are protected by the safe harbor. Like this, in the income tax also, the safe harbor is a mechanism that provides certain margins or prices. So if the taxpayer comply with the margins or the prices and the circumstances, then he is protected from the litigation or scrutiny and everything. So, safe harbor is a new concept, but presumptive taxation was always there. So, it is a kind of a presumptive taxation also. So, but it is for the international transaction, the new concept was introduced in 2009, but rules could not be framed. So, because there are not many countries in the world which contain the detailed safe harbor rules. Like transfer pricing, OECD has the guideline, UN has the guideline, many developed country has the guideline. But safe harbor, if you currently also, if you see, apart from certain developing countries like Brazil and all that, none of the advanced countries are having the detailed safe harbor rule. They have the low value adding service kind of safe harbor for 5%, 10%, but not a comprehensive like India. So government appointed a committee under the chairmanship of Sri Rangachari Saab. And then after the recommendation have been received, then in 2013, first time, the safe harbor rule were introduced for certain international transactions, mainly IT, ITS, and service, because India has the age in this sector, and there are many transfer pricing dispute that time in these sectors. So later on, it was extended to specified domestic transactions and also for income determination of the PE also. And so in my view, the safe harbor rules provides several opportunity. So first opportunity is the certainty. What the taxpayer wants. Taxpayer always wants a certainty that I should be known from the starting that this much will be the my tax liability. Like a salaried person, he knows in the beginning of the year that if my salary is suppose 20 lakh, then this much will be the tax. But when the multinational group acts in the different economies, they follow the transfer pricing. And transfer pricing is not a science. So nobody can say that this is the price which is objectively can be determined. So this is it is a kind of the there is subjectivity involved in this. So every multinational group is worried that if I'm going to certain economies, whether my tax return will be accepted or not, and how much tax liability ultimately I have to pay. So they cannot determine the tax cost. So this safe harbor, suppose we say for the IT sector now the 15.5 or something. So they know that if my total cost base is 100 crores, so this much will be my operating profit and this much will be the tax. So this is the biggest advantage of the safe harbor, that you don't have any uncertainty. And if some taxpayer are planning suppose 1,000 crores investment, so they can easily calculate the tax outgo. So that is the first major opportunity which the safe harbor provides. And the related that it reduces the litigation also, because once return is accepted, there is no question of any litigation. And this also improve the general environment in the country, that ease of doing and all that. And people think that okay, tax is not an issue. So tax is not an issue. Other consideration you can see, and it also promote the voluntary compliance. Suppose people know from the beginning that this much my tax and this is the easy procedure, so they try to comply with voluntary with this. So these are the, I think, major opportunity or advantage of safe harbor. So as regard limitation, before introduction of the new tax rule 2026, there were many limitations. Like in the ITS, there were fragmentation. That KPO was different, ITS was different, IT was different, research and development was different. So, and that margin also varied from 17 to 24% and all that. But after introduction of 2026 rules, now all the services, IT services are combined under one bracket, and one margin has been prescribed. So this was a limitation uh, before 25, but going forward from tax year 25-26, I think this limitation has been largely been addressed by the new rules. Another limitation was there that only the low or small taxpayer were eligible, because the turnover limit was there, 300 crores. So due to the inflation and increase in the Indian economy, 300 crore is a little bit lower amount. So now the government in the new law has increased to 2,000 crore. So 2,000 crore, I think that covers all the most of the IT sector. If they are very big, so they are very big, then they are complex. The very big are out of that, but 2,000 crore, that limitation has gone, and all the small firm or medium firm will be eligible for safe harbor. Then another limitation earlier was the manual processing, that TPO used to examine that what is your FAR and all that. So there was apprehension. So, but now the automated procedure has been introduced, that DG system will automatically, through the system, it will verify, and that I think very simple procedure will be there. So this this will also reduce the limitation of the safe harbor rule as it existed before the 2025 Act. And another problem or limitation, we can say that government used to notify every year the rate. So there was no certainty that suppose this year the rate is 17%, next year it may be 19%. But now in the new rule, that block concept has come, the 3-year block and 5-year block for IT services. So 3-year block is there, and you can opt for 5 years. So this also brings a kind of certainty in the minds of the taxpayer. So these are the limitations of the earlier safe harbor rule, which has been taken care of. But I cannot say that there is no limitation currently as well. All the presumptive scheme will have the limitation, because you cannot give the presumptive scheme to the complex cases. Suppose there is manufacturing complex cases. There are 18 transactions, the raw material purchase, royalty, IGS. That kind of transaction cannot be brought to the safe harbor. So that are the inherent limitations, that no safe harbor can provide the safe harbor for these type of transactions. But wherever the service industry and the simple transactions are there, the safe harbor rule already provides, and the new safe harbor takes care of that. And for the complex transaction, as you are aware that government has increased its focus on the APA program. So in APA, the complex cases can be taken. So in the APA, as you may have noted in the media, that this year we have signed 19 agreements, and so all the what the policy direction regarding the transfer pricing dispute is that the simple cases should go to the safe harbor, and the complex cases should come to the AP. AP also provides thing, certainty. Only thing is that is a lengthy process because the examination is there. But once if there's a complex transaction or the volume is large, so if that is the issue, that so APA can be taken for the complex and the simple for simple, the safe harbor can be taken. And alongside the safe harbor and APA, if both combine will I am fully sure, or I am very much thinking that this will provide a good platform for the certainty, and in future we will have less number of transfer pricing dispute, and this will encourage the investment, and that will spur the growth of. So thank you, and thank you once again for inviting me.
Thank you. Thank you very much, sir. Thank you a lot. Thank you for your time. And now comes the most awaited part of this today's session, the technical presentation. It's my privilege to invite and introduce our esteemed speaker today, CA Jay Kumar Tejwani sir. He is a senior chartered accountant with over 30 years of experience. He is specialized in the direct and international taxation, FEMA, and assurance services, and regularly represent matters before tax appellate authorities. He is a frequent speaker on international taxation, UAE corporate tax, union budgets, and DTAAs at ICAIs and corporate forums. Since 2009, he has been associated with ICAI as a faculty member. He is also contributed to preparing study materials and professional publications in taxation. Sir is widely respected for his deep technical expertise and practical insights in international taxation, particularly in transfer pricing and regulatory framework. We are confident that today's session will immensely enrich our under your guidance, sir. Without taking much of your time, I now invite CA Jay Kumar Tejwani sir to take us through the topic today's topic, safe harbor rules, opportunities or limitations. Sir, the virtual floor is all yours.
Thank you, Mohit. Thank you very much. You have to confirm if I'm audible.
Yes, sir.
Okay,
Completely all right.
great. Okay, so let me start with my presentation. Please confirm if the presentation is
Visible?
is it visible?
No, sir, not yet.
Okay, okay, no problems. Just give me a minute, yeah.
Till the time, I would like to remind our participants to keep sharing their question and answers through question and answer box. Yes, sir. Now we are getting a screen, but please open up the presentation slide.
Is it visible now?
Your screen is visible, not slide.
Oh, not yet the presentation. Okay,
Yeah.
okay. I'll again stop share and reshare. Okay.
Okay, sir, take your time.
Is it
Yes, sir. Perfectly all right.
perfectly all right? Great. So thank you very much, and let me start
Yes, sir.
the presentation.
Sure.
And number one, I must thank Chairman Sir Satish Kumar Gupta ji, the Vice Chairman Sir Vishnu Agarwal ji, and our very esteemed guest Rajesh Kumar Bhoot ji, and of course to you, Mohit. Thank you very much for wonderful introduction, and I also welcome all the participants. 900 plus is a big number. So the Institute of Chartered Accountants, with their motto being Ya Eshu Supateshu Jagrati, we are awake when everybody is sleeping. So today's topic is safe harbor rules, opportunity or limitation. And safe harbor, the presentation which we are going to discuss is based on the Income Tax Act of 2025, which was recently enacted and which is effective from April 1 of 2026, and also on the income tax rules of 2026, which was approved by both the sessions of Parliament on 20th March. And as mentioned by Rajesh Kumar sir, safe harbor actually is a key component of the Indian transfer pricing. And it actually delivers three very important things. One is the certainty. Second is the improvement in ease of doing business. And third, reducing the litigation. We all, whosoever is practicing the transfer pricing litigation, would have noted number of challenges which we face while putting in our case for the margins or the comparables. So with this new rule coming in, which is actually very exciting, now it appears that apart from certainty, there would be reduction in the litigations as well. And let me introduce what actually safe harbor is. What is safe harbor? So safe harbor represents, basically, it's a policy driven shift from the scrutiny to elective certainty, where now the taxpayers, they consciously, after doing their transfer pricing review, elect for the predictability and precision of their transactions. It's a mechanism where if the taxpayer follows the prescribed margins which are given in the rules or the conditions which are given therein, the tax authorities, without questioning, would accept the transfer pricing without getting into much detailed scrutiny. So, therefore, as mentioned in the previous slide, there is a certainty in exchange for the standardization. And what actually happened in budget of 2026 and the enactment of the Income Tax Act of 2025 and the rules, safe harbor actually has become a big opportunity for all of us. And we are going to talk about the opportunities which the amendments which have been brought in. And the important point here is there's one section, just one section, which is section 167 of the Income Tax Act 2025, which empowers the CBDT to prescribe the conditions under which the transfer pricing declared under section 9 subsection 2 shall be accepted without detailed scrutiny. Very simple section empowering the CBDT. And then the important rules which are connected with safe harbor, they start from rule number 86 and go up to rule number 102. But the backbone of the rules is rule number 89. Rule 89, it defines three very, very important concepts. Number one, who is the eligible SSC who can take the benefit of safe harbor? What are the eligible international transactions which get covered under the safe harbor? And 89, as I mentioned, is the backbone as it prescribes the margins under various categories and also the conditions in terms of threshold, in terms of availment, in terms of what happens if the things do not work out. So, this is what section 167 read with rule 89 does. But before getting on to rule 89, which I'm going to take in more details, let's still talk about the need for transfer pricing safe harbor rules. Is it actually from now litigation to predictable certainty, which Union budget has brought in? Yes, earlier the challenges were, particularly under the IT, the margins were as high as 24%, starting from 17%. And there were very complex conditions to be fulfilled because it was divided into software services, into KPO services, R&Ds. But with the current union budget, all these four elements are now covered under information technology services with the fixed margin of up to 15.50%. 15.50% or more. Minimum is 15.50% or more. And third, very important is that the safe harbor procedure is now fully automated. Of course, once it goes to the automatic process, if you file it, if everything is good, you get the approval maybe as fast as within 2 months. If nothing comes, it's a deemed approval. But if there are any challenges for validation or verification, the AO may send it to TPO for the validation and verification of facts. But this is something very exciting, which the union budget of 2026 has brought in. And keep it in mind, we are going to talk about the opportunities in more details. So, three big reforms which the budget of 2026. Number one, now there is a single IT category, just single IT category, comprising the software development, the information technology enabled services, the KPO, BPO services, and the contract R&D services. Number one. And number two, the most wonderful thing which has happened is that now the threshold, which earlier was the entities up to 300 crores were allowed to opt for safe harbor. Now that limit has gone to 2,000 crores, bringing in mid to large companies into the scope. And one very interesting fact I would like to add that CBDT came out with a small press note that with limit increasing to 2,000 crores, there are only 100 companies left which are beyond the safe harbor. So only 100 companies having turnover beyond 2,000 crores for the segment we are talking about. That is the information technology sector. Okay. And out of these 100, again, 60 anyways are very, very big and they are before 80. And 40 we assume will also get covered under the safe harbor rule. So this is something very exciting for all of us who are practicing. And the second thing which Rajesh sir also mentioned, is that there is a certainty. There is a 5-year certainty block. So if the safe harbor is approved, it is valid for 5-year block. Otherwise, the challenges which were faced earlier, now they are eliminated for filing the annual compliances, providing the planning on year basis. So 5-year is something which is of great help, I'm sure. And third, and very, very important again, is that the process is fully rule driven and it is automatic. The discretionary power with the tax officers, etc., is now to a larger extent is done away with. And the most important part is the approval will definitely come within 3 to 4 months. And if for any reason it is not approved, we still have the option to put in the application again with the required defects in the earlier approval. Okay. So this is how the three reforms have happened. And another very important, one last line of which you must note is that it protects the margin. Safe harbor protects the margin. So if there is, say, a margin of 15.5% or a cap of 2000, but the documentation still needs to be maintained. You still have to have the TP study done. You still have to have the filing of Form 48, the CBCR report, the master file, the local file. They all have to be still complied with. So this is what the opportunity is, which has been brought in through. And wherever you feel that I am not audible, do let me know. Okay, this is first. And the last slide with this change is that, as Booth sir also mentioned, that there still exists the other alternatives. But one alternative which gets the constraint is the MAP. Once the safe harbor is approved, the SSC cannot opt for or cannot invoke the MAP provision under the tax treaty. This is one, maybe a challenge. Second is there is no tolerance band. As we are all aware that within the transfer pricing adjustment, there's a tolerance band of plus minus 1 to 3%. But once you have the safe harbor, if it is 15.50 for IT services, then it is 15.50 IT services. Okay, but then what are the other positives which are there with the safe harbor? One is, as I mentioned earlier, and as have been mentioned regularly by the other speakers, that approval is as fast as 3-4 months. And it is all automated with a block period of 5 years. And the most important, that the cost involved is significantly low. There is no filing fee. So the cost would be the cost of the professional or maybe the teamwork which is working on the initial application by the company. And second, if we compare it with other alternatives, MAP and APAs are still available, but of course, MAP gets barred if the safe harbor is opted and approved. So mutual agreement procedure generally takes 3 years or more, with a lot of documentation, lot of queries to be answered, lot of documents which flow in and out. And second, the advanced pricing arrangements or APAs, which generally takes not less than 3 years because it is basically a negotiation. APAs are basically a very, very detailed procedure wherein the information in terms of documentation, justification, visits by the tax officers, it gets involved. So, of late, of course, Rajesh sir mentioned that during this period, 200 plus APAs have been signed. But otherwise, as of now, the process is not very fast. And then the third option, which anyways is always there, is opting for the judicial route, going to DRP, CIT, ITAT, High Court, Supreme Court, etc. But this entire process takes not less than 6 years and could go even more. Significant cost involved, not of the professional, but even your own team. A lot of documentation flows, submissions of various justifications, invoices, agreements, etc. gets involved. So out of the three, third one, most time consuming in terms of documentation, efforts. Second, not less consuming because APA is actually a negotiation. So again, a lot of documentation, presentations, and professional cost and the company's own cost gets involved. Safe harbor. Once your application is done correctly, you are able to fill in all the relevant clauses. It is the fastest approval of 3 to 4 months on the higher side. Okay, so these are the three slides which were important from the Union Budget of 2026. Now, let me again travel you to rule number 89 again. So 89, as I mentioned, is one of the most important rules out of 86 to 102. And the core framework of this rule is that it says that declared transfer pricing shall be accepted where the option is not rejected by the officer or through the automatic process. And the conditions which are given under subsection 2 are fully met. So once your application is filed, it is not rejected, and all the conditions are met, safe harbor becomes activate. Rule 2, again, very, very important rule, that what are the eligible transactions which you can opt for under safe harbor. So as Mr. Booth mentioned, that not all transactions as of now are covered. So basically the transactions which are covered for safe harbor could be categorized under 4 segments. One is the service transactions. This is very, very important from the practice perspective. Second is the auto manufacturing transactions. Third is about the loan, inbound and outbound, categorized under financial transactions. And fourth is more about the miscellaneous reimbursements or commission guarantee, etc. So these are the eligible transactions. And we are going to talk about all the segments separately. Service, manufacturing, financial and others. SMFO, in short, we call it. SMFO. So let's look at the service sector. Service sector, as I mentioned, for safe harbor has always been the most important one. Number one is the information technology services. As we mentioned in the initial slides, that 4 services: software development, KPOs, the R&D, and ITES services, wherein the margins were different in the earlier rules, ranging from 17 to 24%. They have now been aligned under information technology services, wherein the minimum margin is fixed at 15.50% of the operating cost. So the PLI, profit level indicator, is operating profit upon operating expenses. So it is not on sales, but it is on your operating expenses. We are going to understand this through a case study later. The second, very important, is that revenue, the top line, the revenue has to be either less than but up to 2000 crores. And with such an extension from 300 to 2000 crores, almost all the companies providing information technology services, they get covered under safe harbor, except 100 companies which are bigger than this limit. And out of those 100, as I mentioned, 60 anyways are before APAs and only 40 are left. And again, all their participants, this is the most important actually from the safe harbor perspective. This is where we practice. We help our clients in doing the TP diagnostic review. We help the clients in putting in the metrics of cost versus benefits. We call it a benefit matrix. And the area which concerns a lot of organizations in India, and particularly people from Mumbai, Delhi, Bangalore, Hyderabad, Chennai, they could immediately relate the practice area versus this safe harbor. Another very interesting addition in the service sector is the data services center services. And I'm sure you would all recollect that Government of India is now pushing in for putting the data centers in India. And also within the union budget, which is now the Income Tax Act as well, the foreign companies will have to hire the resident companies, the companies which are resident in India, to provide the data center services. Though the profits are all exempt under Schedule 4, but at the same time, the government has specified that these data centers, which are Indian residents and operating for the foreign companies, should maintain the operating profit margin of not less than 15%. This being something very new, very exciting, opening a lot of opportunities for CAs as well, the understanding of the concept becomes very important. It is, though it's very, very new, not much live cases here, but it is a forward looking, inclusive understanding which is reflecting the emerging sector policy orientation. The next few years, the demography of our practice could really change with the data center services becoming predominant. So these two, I feel, from a perspective of practice, could be quite a exciting field. Where we were expecting some changes, but it has not happened, is the contract R&D of generic pharmaceuticals, where the research and development through a contractual services are done. The operating profit margins have not reduced. They have still remained at 24%. And of course, the revenue threshold is now increased to 300 crores. But this particular service sector remains the challenge because this is among us the highest margin in the entire safe harbor, manufacturing, financial or otherwise, where in the margins have not reduced. Okay. So this is about the service sector. Now, let's move to the manufacturing and financial sector. Manufacturing transactions. So manufacturing is divided into two. So companies which are manufacturing the core auto components, the auto components which become the core part of auto manufacturing, through which the machine runs or the vehicle runs. The companies have to maintain the operating margin of 12%. And wherever and whenever I'm talking about the operating margins, the PLI, profit level indicator, is always the operating profit upon the operating expenses. Similarly, companies which are into the non-core auto components, the outside, the interiors, the paints, the covers, glasses, the operating margin of 8.5% is to be maintained there. Again, very, very exciting area in terms of practice. But the only challenge is that unlike the service where the block period is 5 years, here the block is 3 years. And the limit is very, very less, which is just 300 crores. Third is the financial sector or the financial transactions. Here, if there is a loan which is denominated in Indian rupees, the interest rate to be applied is the SBI's marginal cost of fund based lending rate. In short, we call it SBI MCLR plus 175 to 425 BPS. That is 1.75% to 4.25% additional, depending on what kind of credit rating you fall under. Whether you're the top with AAA plus or you are in the negatives. So BPS accordingly gets determined. If the loans are foreign currency denominated, if it's a US based, then SOFR, earlier it was LIBOR, becomes applicable. The definitions I'm going to give it in the next slide. If it's a euro bond, then euro IBOR. If it's a UK, then it could be SONIA, so and SUN-IA. So that would be the benchmark. Like in India, we have SBI, so that would be the benchmark plus 150 to 600 BPS, depending on the credit rate. Okay, so these are the broad categories for manufacturing and financial. And the last category is others. Others basically include the corporate guarantee commission, which we were actually expecting to get reduced, but it has not been. So corporate commission rate, if any Indian has given a parent has given a guarantee, corporate guarantee, the commission rate is minimum 1% per annum. And as we are practicing a lot in this, 1% floor is very, very high than the market rates for the strong parent guarantees. Again, the corporate guarantee becomes a challenge, not an opportunity. There could be cases, of course, which I have not seen, where one person is okay, but generally it is 0.25 to 0.5%. Another case is the low value adding intra-group services, only intra-group service. There is intra-group which is providing some services to another associated enterprises, then the markup up to with a minimum of 5% has to be maintained. Okay, so these are the other categories. Okay, to summarize, service sector 15.50, and second, within service sector 15% for data centers. Third, R&D for the pharmaceutical, generic pharmaceutical, 24%, which is a challenge. Then we talked about the manufacturing, core auto component 12%, non-core auto components 8.5, financial transaction which are INR based, SBI rate plus 175 to 425 BPS. And for foreign currency denominated rate, respective banks, SOFR or Euro IBOR, with 150 to 600 BPS. Okay, in the last, and I think one point is missing here, which I'm going to add. Others include the corporate guarantee commission. If the parent has given a corporate guarantee, 1% is what is, as per safe harbor, is to be recovered, which, as I mentioned, seems to be very, very high as compared to 0.25 to 5%, 0.5%. Similarly, if there are any low value adding services which are more intra-group, then the markup of 5% is to be maintained. And this actually is a good option. Last one is good. Okay, so this is how, what we have discussed so far, it gets covered under these four categories. Number one, the rationalized margins for IT services, expanded threshold, particularly for IT services, market-linked benchmarks like MCLR, SOFR, Euro IBOR, SONIA, they are all market-linked, but the BPS at times looks very, very high. And initially, as I mentioned, that with warehousing and the data centers coming into picture, the safe harbor are quite the forward-looking. And also for us, my friends, this is critical. Safe harbor for a practicing chartered accountant becomes important from a practice perspective. So 89.1, 89.2, and then 89 subsection 3. It gives certain definitions and some kind of a reference rate. So these are the globally accepted benchmark rates. For USD, it is SOFR, secured overnight financing rates. Earlier, it was LIBOR. Euro IBOR, Euro Interbank Offered Rates, SONIA, Sterling Overnight Index Average Rate. And again, as I mentioned, the BPS is dependent on the credit rating. And if you have got the credit rating done through multiple agencies, then the lowest rating prevails. Okay, so in other words, the rating shopping is not allowed. Okay, very smartly, this is again a change. And the new concept is rating shopping not allowed. Then 89.4, it gives the block period and the procedural part. So block period for IT, we mentioned 5 years, for others 3 years. But the process is very, very automated now. It is through Form 49, which is now a single form. Earlier there were 3 forms. Safe harbor for international transactions was separate, specified was separate, business was separate. Now everything gets consolidated under form number 49. And Form 49 is to be filed just before the due date of filing your tax return. So if the due date for transfer pricing form is the 31st October, the form number 49 is to be filed earlier than that. The documentation is much simplified now, as against APA, MAP, or regular appellate proceedings. The basic documentation in terms of your explanation and detailed note on the activities, etc., is to be filed. And one form, single election, covers all eligible transaction for the block period. The form is very, very detailed. If time permits, I may show you the form as well. Okay. So the block and the form. But one very important challenge or significant challenge that is to be kept in mind is that a marginal shortfall in any single year can disqualify the entire 5-year block. Therefore, you have to be very, very clear while doing your diagnostic study or preparing your benefit matrix that for the block period you are going to at least have the margin of 15.50%. Otherwise, the entire exercise gets defunct and the benefit of safe harbor can be lost. Okay, so opportunities and loss together. And then there are other 2 subsections, which is subsection 5 and 6. So 5 says that once accepted, tax authorities cannot do any other adjustment. Here I would like to add one thing, that scrutiny may still happen if you cross the threshold and if there are any other transactions. The AP officer may still validate and verify whether the safe harbor, say for IT, you are actually IT still, you are fulfilling all the conditions, and there is no significant difference between what you filed at the time of application versus that year. And if everything is correct, he cannot make any other adjustment. Similarly, uh, once accepted, this locks the taxpayer. So this is a kind of a limitation or a challenge. One is the opportunity, but the challenge is that you actually get locked in the prescribed framework, irrespective of the economic variations. Let me help you with the example to understand this. So currently, particularly in the financial years of 24-25 and more in 25-26 and very significant in the ongoing years, suddenly the AI has come into picture in significant variation. So we have seen a lot of our clients which are into IT actually suffering from the maintenance of their otherwise also the margins which they were earning. So one side opportunity, but the limitation is that you actually get blocked in the prescribed framework, irrespective of what is going on in the economics, the war, like situation or the actual war. It could really impact our margins. We may be ready to at least work even for a lower margin. So all these things, while we are doing our study, while we are doing our metrics, they have to be kept in mind. 89 subsection 6, it says that if you are within the broad parameters, the tax officers, the TP officers will accept your margins, but you still have to maintain the complete documentation. So the TP documentation, or we call it TP study, still has to be maintained. Of course, you need not be taking out the comparables now, but you have to still mention that your segment, your IT segment, or whichever safe harbor you have followed, has not changed. And it has to be mentioned in great details again. The filing of Form 48 by the accountant still remains the same. The report is not exempted. So, in other words, safe harbor redefines the nature of compliance, but it does not reduce it. In earlier times, we had seen that taxpayer was doing certain mistakes, but taxpayer must not mistake pricing certainty by keeping less documentation. Absolutely at no time you can, tax officers can always ask for the documentation. It is more a relief. Safe harbor is more a relief than a policy. Okay, so this was about Form 89. Okay. Now let's look at the policy shift which has happened, which is bringing us a lot of opportunities. Why this topic? Safe harbor opportunity or challenges? Why? Because with Union Budget of 2026, with new rules coming into place, ICI felt that there is a significant opportunity for the small to medium tax practitioners as well. So, number one, it is of course a revenue protective approach. Original regime focused on protecting the tax base with high margins and narrow eligibility. So, as an example, with a tax margin, with a profit margin between 17 to 24%, whereas, as Mr. Booth also mentioned, that it is not very scientific, but of late, when we are actually doing the TP documentation, TP study, we find that the margins are between 12 to maybe 15, 16% only. Not that it is any more art. We actually, of late, we have become more knowledgeable now to ensure that we meet the industry margins. So, as earlier, it was more the tax base with high margins and narrow eligibility, but the policy has now evolved, wherein the reduction in the prescribed margins, which are more aligned to the industry margins, expansion of the threshold from just minimum of 300 to 2,000 crores, then alignment of all these KPOs, BPOs, ITES software into one, and making it automatic has actually evolved as a policy, and efforts from the government side are to make safe harbor more inclusive, to bring in the certainty, to bring in a more SSC favorable regime in place. And also we should align with the global best tax practices. And as was mentioned earlier, Currently, the global best tax practices are not much on safe harbor. So India actually is leading the safe harbor with detailing out whatever we are discussing today, with detailing out the forms, the rules, the sections, the procedures in a very simplified manner. And India actually could become a leader in safe harbor. Okay, so this is what the policy shift is. So now let's understand again through examples the service industry, manufacturing, the financial sector, and others. Okay, so we are taking the first case of IT service provider, which comprises of now the software development, ITES, KPOs, and basic R&D. So operating cost base is 100 CR, and currently the company's margin is 13%, 13%, resulting in the operating profit. And we have assumed that 13 CR is on the cost because 100 is the cost, not the revenue. And if the company opts for safe harbor, the minimum margin they have to maintain is 15.50%, resulting in the operating profit of 15.50 CR, resulting in the additional taxable income of 2.50 CR. Okay. So impact would be higher tax at the rate of almost 25% if it's an entity, or 35% if it is not an entity. So suppose on this very basic of 2.5 CR, for an entity, the tax would be almost 60 plus lakhs, 60 lakhs. Please understand the example carefully because you are now doing the TP diagnostics and you have found out this fact. So now we are going to put in the effort whether paying 62 lakhs and buying the piece for at least next 5 years is better, or fighting for the margin of 13%, getting into the litigations through whatever mode we offer, more time, more energies, efforts, the charges. This is what comes in when we actually do the study, when we do the diagnostics or the matrices. So it is suitable only if the entity can. And okay, so this is one. Number two, also you have to ensure, as we saw in the previous slides, that 15.5% is what is going to be maintained the next 5 years. If it is below, you have to still offer an adjustment to make it equivalent to 15.50. If you don't do it, you lose the entire safe harbor benefit. Okay, so this is what is to be done. This is how we prepare the metrics. Of course, this is a very simple example, but yeah, something which is to be considered while putting in the numbers in place. Case number two is where the INR denominated loans are given. Say the loan amount is 80 CR. The interest rate which currently we are charging is 10.75%. But if we follow the safe harbor with say a mid-size rating with SBI plus 250 BPS, the rate becomes 11.25%. So the impact is 50 BPS. Interest income, which currently you are earning, is 8.60 crores. With the 11.25%, it would increase to 9 CR, which means that there is an additional taxable income of 0.40 CR. Again, if it is at 25.17%, it would lead to the additional tax of more than 10 lakhs. Key observation again while doing the matrix that it becomes attractive safe harbor when actual interest rate is below the prescribed spread for the applicable credit rating. That is, the credit rating is so good that we are around or less than 10.75 CR. But at times, to borrow peace to ensure less efforts, to avoid duplication of services, the charges, etc., you may still, while doing your metrics, putting in the 5 years in place, considering the other costs, etc., you may still find it okay to go with the safe harbor. So these examples are to explain what is to be done when we do the actual metrics. And we are actually doing a number of cases have actually up to us wherein companies now want to do the diagnostic review of the transfer pricing. And these are all quite real time, but I have, figures may be different. Let's take three more examples. One is the foreign currency denominated in the foreign currency, loan denominated in foreign currency. Here the benchmark SOFR we are taking USD 5%, and the credit spread BPS actual position is 130 BPS, but as in previous example, the safe harbor option says 180 BPS. So again the impact of 50 BPS. Total interest rate, if we take the SOFR which is 5% plus 1.30, it makes it 6.3. But if you opt for safe harbor, the interest rate may go up to 6.80. So additional income, that is the income which may increase, will be by 0.50% or 50 BPS. That is approximately USD 50,000. In INR, maybe at 90 rupees considering the current rate. It could be maybe 50 lakhs. Yeah. With 25%, there could be a tax flow of almost one-fourth of it. Again, my friends, you have to put in the 5 years block in place. You have to check all that we have been discussing so far and identify if safe harbor is valid in this case or not. So, case number 1, 2, 3, I still find a lot of opportunities. At least putting in the efforts, advising right could be of help. Case 4 is a corporate guarantee commission, where as of now nothing has happened. But say the guarantee amount by the parent is 200 CR. Commission rate, which actually we are paying is 0.50%, recovering is 0.50. And if you opt for safe harbor, 1% is the minimum. So currently the guarantee fee income is 1 CR. With the safe harbor, it becomes 2 CR. Okay, this is a very simple example that additional taxable income is 1 CR. Here, definitely we could see a significant and a very high tax outflow. And this is a challenge because currently we have number of judicial pronouncements, not just in India but worldwide. OECD also has, a lot of narratives on the margin of 0.25 to 50%, which could help us to sustain our commission of 0.25 to 0.5%. And so this still remains a challenge. The government has to work out the commission rate, maybe to a figure of 0.5 to 0.75%. And fifth, where again, which is a serious challenge, is the contract R&D services related to the generic pharma, which government is giving a lot of attention to the generic pharma. Through example, we can understand that the cost base is 50 CR. The operating margin currently of these generic R&D services is 16%. And if the safe harbor of 24% is accepted, there is almost an increase of 8% margin. 8% itself, on a 16%, 8% is going to impact the operating profit significantly with significant higher tax. So unless you feel that, yes, your say margins are very, very high, and you are quite into litigation, sustaining your current margins, and years, next 5 years, it gets covered under the service, then only you can opt for it. But otherwise, this is also a challenge area as of date. And again, a lot of positive jurisprudence in our favor, wherein the margin between 10 to 15% has been accepted. Okay, so with all these case studies, what actually we understand is that safe harbor must be evaluated transaction by transaction. As we have done in all the 5 cases, you have to put in your metrics clearly, evaluate transaction by transaction. And second, the point which you have to consider while putting in your study is that even a marginal shortfall in 1 year can disqualify the entire 5 year block. Again, detailed scrutiny, challenges, litigations, etc. So be very, very clear that next 5 years are, when you're doing the study, are going to remain constant. Consider the previous 5 years, right from the COVID to till date, the war. These are to be considered very, very carefully. Indian GDP, India suddenly touched four, number 4 to 3 actually. And again, because of these economic situations, they have fallen to position number 6. The way we were 5 trillion, which was talk of the town up to last year, we are again below our regularly maintained position of 5 to 6. So these are always to be considered. Second, we have to compare the incremental tax cost, as we have been discussing throughout, versus the litigation, the risks, the compliances, the cost, and the savings. So this is just one side which I have given. The other side would be what kind of savings are you going to make? The fees to be given to professionals, the charges on your own staff, the time, effort, the opportunity cost. If your team is saved, they can do much, much better and much more. So all those things very diligently have to be applied. And again, the documentation of eligibility is very, very critical. We cannot take any assumptions. So as why, it is said that TP is more an art, work of art than science, because we do a lot of assumptions. But in safe harbor, the determination of operating expenses and the classification of your credit rating is exceptionally critical. So these are the two key takeaways with opportunities as well as the challenges or the limitations. I hope the things are clear. Okay. So again, the same chart which we have discussed, safe harbor gives you certainty, but it has low flexibility and moderate cost. Advanced pricing arrangement gives you very high certainty with 5 years plus rollback of 4 years. And but the only challenge is long time and significantly higher cost. Litigation, absolutely no certainty. Every year it could change. And a very, very long time. As I mentioned, if you're in High Court, minimum of 6 years, and Supreme Court, much more. The cost, again, could be high in this case. Okay. These points are important while you are actually analyzing the safe harbor for a client. And the opportunities and the challenges again in a slide mode. So as we have discussed, the opportunities are that safe harbor gives you certainty and reduction in your litigations. Then there is a tax predictability. So while you are putting up your financial planning and budgeting, you are aware the tax outcome of next 3 to 5 years. And administrative efficiency, it reduces the assessment and audit intensity and compliance burden. Not that it is you're not free of compliances, But at least you're aware that TP study would only talk about the load, and it also frees your staff, your resources, which again is an underlining point for your core business. In a lot of companies, we see that the teams are dedicated for doing the APAs or the long prolonged litigations. Here, the either the resources may not be hired, or if hired, they could be used for the core business activities. So these three are the opportunities, and of course, APA MAP still remains the alternative. And safe harbor is more useful where the entities are the low risk entities. They are in more routine natured jobs, which are non complex. Okay. Like ITES, as I mentioned, is a very is a kind of a back-end service with low risk on you. The parent entity, or say in India, we are doing a KPO service. The parent entity, wherever they are situated, say in US, will be taking the higher risk. We have no risk of recovery. We have no risk of products, nothing. But it's a routine job. It's a routine, regular job. Third, it's a non-complex job. So in all such cases, the safe harbor may be very, very useful. But where the issues involved are not covered under safe harbor, they are more complex, entailing the intangibles, royalties, services, higher end manufacturings, large intra-group services, APA may be an alternate. Okay. So in companies where there are both complex and non-complex, they could also go for the hybrid strategy. Safe harbor for transactions which are covered under what we just discussed. Plus, they may also go for AP for the complex transaction. And overall, with the new areas getting added like data centers and warehousing, which the policy signaling now that we may now go for a very thoughtful practice for the company as well as for ourselves in a much better and investment friendly environment. Okay. Challenges which still remain, and again discussing it maybe further. That number one, all or nothing. Any breach of condition in any year may invalidate the entire option for a block period, and which may create significant exposure, not just for taxes, but even significant penalties. And second challenge is that in R&D, the margin of 24% actually reduces the commercial feasibility for opting safe harbor. And again, another risk which at least we are realizing as a practicing person, that once the safe harbor is approved, the restriction on the excess of mutual agreement procedures. And fourth is over standardization. As in the last basics of transfer pricing, we discussed that FAR is very, very important, functions, assets, and risk involved. But here it is just standardized. Standardized on the basis of whatever parameters have been considered, with no specific analysis of function, assets, and risks. Okay. And 5-year lock-in period, as I mentioned, in the cyclical industries or where the industries get impacted because of any eventuality, the 5 years may actually be with no flexibility. Actually, even if with flexibility, there's a flexibility that, okay, if there is a situation, this again becomes a challenge. And cross-border restrictions. So in India, you have a 15.50%, which the say Indian entity has to recover. But the US says no, we would not allow more than 10%. So there is always a double taxation challenge. Again, in your metrics, the understanding of DPAA and the rates and the mismatch, they have to be identified to identify the to actually determine the actual cost. Okay. So these are the challenges. So it is not a shortcut. Safe harbor is not a shortcut. You still have to maintain the documentation, you still have all the compliance obligations, but it is a opportunity for certain industries, including the ITES, to be maintained at a standardized rates. Okay. So from a strategic perspective, and this is again for all of us, very, very important. So the most effective approach for safe harbor is, as I mentioned, for a very routine, low risk transactions where the intangibles are not in your name, they are owned by, say, the foreign entity. The risks are majorly taken by the entities abroad. You are only the service provider or the backend service provider. It's a routine service, not involving too much of technicalities. Safe harbor could be a very good option. Whereas APA is for highly complex transactions like AMP, royalty, some GCS services, and the value is high, very, very high value transactions. APA could be opted for that. And MAP, if you are not in safe harbor, there is a treaty mismatch. MAP still could be a good option. But APA, MAP, 3 years plus a lot of cost. Okay. So otherwise, as a strategy, number one, when we are doing the study, quantitative evaluation is to be done. Incremental tax cost is to be compared with the opportunity cost. Your team getting employed in other core businesses, that cost is to be taken. Litigation risk, compliances, tax savings, etc. They have to be compared. Functional alignment, ensure that the business model, the cost, and the margin align with the prescribed conditions in next 5 years. Cross-border, as I mentioned, evaluate if there is any foreign tax credit implication, whether 15.5% is here, whereas only 10% is allowed, or 20% is allowed abroad. So you lose the tax credit. Similarly, MAP restriction, is it really bringing in any kind of a constraint? Which, in my opinion, for a lot of big companies, particularly 1,500 plus, MAP restriction is impacting taking a decision on safe harbor or not. Okay, so these are the three strategic points. The presentation is available on the DHL portal of ICAI. Okay, now let's look at the global practices. And we'll talk about countries like US, we'll talk about China, we'll talk about Brazil, etc. But before that, let's understand the OECD note, the OECD perspective on the safe harbor. So the global trend, as per OECD note, is targeted, and it is more a sector specific rather than the broad-based regimes. So the globe doesn't balance the simplicity with arm's length integrity. India also doesn't. Arm's length is still to be maintained. Huh? India doesn't say that once you have a safe harbor, you do not do the arm's length. No. So that arm's length is something different. Safe harbor is something different. Okay. So OECD says uh, that safe harbor is definitely a very useful administrative mechanism, but the challenges which it highlights is that there may be double taxation arising from the asymmetric treatment in different jurisdictions, and it may lead to deviation from the arm's length principle. So if we keep these 2 points while advising our clients, the OECD's perspective may also be considered. OECD again talks about the low value adding services with limited risk, which are routine in nature and which are not complex for the safe harbor. It again advises for the advanced pricing agreements for the complex transactions. Okay. So following the OECD, what US is doing? US approach is very, very narrow and transaction specific. So we are not very different from US. We also have a transaction based approach only. But US follows a very narrow transaction specific approach, and it says that safe harbor can only apply to a low value adding service. And they say if it's a very, very low value adding service, even the cost without markup is doable. But it emphasizes the strong documentation. It says no, if you have a safe harbor, it doesn't mean that you do not maintain the documents. So India also has the same policy. Third, it says that the scope is very limited to the service industry, not for manufacturing or financial transactions. US again talks about the APA as the preferred certainty mechanism. The only difference in APAs of India and abroad is that India takes a lot of time, 3 to even more years. There, at least, they are within the prescribed time periods. So, therefore, even APA there may be opted with a defined time period. So, this is what US is. Then, as far as European unions are concerned, again, it is very limited in scope. It is again primarily focused on the SMEs or entities with low risk routine transactions, not a broad based concept. And European unions put a lot of importance to the advanced rulings and the APAs. And because according to them, it gives the primary certainty for the complex transactions. So let's understand what is India's position after understanding US and European Union. So India's revised safe harbor represents actually a very mature and a much detailed, globally aligned approach. For the first time, India incorporates internationally accepted benchmarks. It is not just saying SBI. No, it talks about SOFR, it talks about Euro IBOR, it talks about SONIA. Second, so this is the positive side. Second is it covers a broad range of transaction than most comparable regimes of US, Europe, and others. So the segments are divided into four: service, you have manufacturing, you have others, and financials. India position also balances the revenue protection versus ensuring that investment is not hampered because of a very rigor litigation process. And as Rajesh Kumar sir mentioned, that because of a very rigorous litigations, the international companies were not forthcoming to invest in India. So India is trying to balance the revenue protection versus the investment facilitation. And the best part is that India is now signaling the reduction in TP litigation. As of now, the number of cases which are pending. So let me exclude the let me exclude the complex. Even the non-complex issues are 10,000 CR in terms of taxes, where the government is aware that as soon as it goes to ITAT or High Court, maybe the 10,000 becomes not even 1,000. So, a lot of efforts from the government as well as from the appellate and SS. So, The main benefit of the safe harbor under the Income Tax Act of 2025 is that it is not merely a compliance, it is a strategic instrument, my friends, for managing the transfer pricing risk in the current increasingly complex global environment. Okay, but let's also look at the other countries. But this is the final position of India, which is making its safe harbor stand out. The globe is looking at India's safe harbor policies and rules. Okay, as far as Brazil is concerned, again, it has a fixed margin model. China again has the selective limited safe harbor. India is amongst the most comprehensive and the margin regime globally. Okay, and so this is what we have discussed. That developed economies like US, European Union, etc., they prefer narrow and targeted safe harbors. Emerging like India, including Brazil, we are into a greater international alignment, actually leading the safe harbor with the purpose of reduced trace TP disputes. On this, I would like to add one thing that India, being such a big country with litigations in values and volumes significant, in international world, the litigations are very less. Nothing as compared to India. So India is also trying to reduce the TP disputes. Again, the trajectory is that investors' confidence is to be increased. There was a time when, during Vodafone and similar other issues, the FDI virtually stopped investing in India. So India actually, through Safe Harbor, is trying to now get into a much better. So it is evolving from a blunt administrative tool to a calibrated instrument of tax policy. And India's policy reflects the shift clearly. And for all of us as well, to actually get into the more safer practice. So conclusion, safe harbor is ultimately it's leading us to a structured pathway to certainty. A study is important to ensure that it is beneficial to us because generally by reading the rules and sections, it will not become the universally beneficial and the calibrated application is required before we advise or approach the safe harbor. So Mohit has already come. I have just 5 minutes.
Yes,
So
sir.
this is what we have.
It was very
Yes.
session, and we are having continuously getting some questions from the participants. Shall we carry on with the question answer session, sir?
Just give me 5 minutes. I'm done
Yes.
with my presentation. So
Yes.
we'll take up the questions at the end. Yeah. Just give
No
me
issue.
5 minutes. Yeah. So this is the last, actually, this is the last slide. Uh, So new categories which have been added in Safe Harbor are the two new introductions by the Union Budget of 2026. One was the data centers and other was the component warehousing. Data centers, we just read that this is a newly introduced for the resident entities and which is going to change the economics of India as well as our practice area. And being a proactive, 15% on cost is what is required to be maintained as an arm's length in India. And it, of course, supports the India's growing infrastructure and data infrastructure ecosystems. Similarly, another one which is called as the component warehousing introduced through union budget. So there are companies, which require non-residents, which require storing components in bonded warehouse. So again, the government says, okay, even if you have the 2% of the invoice value, safe harbor margin on the bonded warehouse components, that is sufficient. This is the lowest actually. So this kind of clarification, which earlier was not there, it facilitates the global supply chain operations. and significantly reduces the transfer pricing risk for the warehousing arrangements. Opt in, opt out through Form 49. I think time doesn't permit, but you have this slide. You can always go through the form. There are multiple FAQs in this presentation to answer a lot of your questions. This is again the entire summary of whatever we have read so far. And yeah, we'll now take up question and answers, but you have to just give me 2-3 minutes before I join back. Yeah, Mohit, I'll just take a break, 2-3 minutes break. In the meantime, you
Yes, sir.
can just, yeah. So here I would just like to say that chartered accountants are the persons who are awake when most of our clients are sleeping. Okay. So just 2-3 minutes and I'm going to be back shortly.
No issues, sir. Till the time, I would like to request all the participants kindly submit their queries, if any, about this session or the topic to the learned speaker, C. Jai Kumar Tejwani, sir, who had taken the seminar very well. And this is to update you all. We will try to make a mail to the mass mail to all the participants for the uh, presentation which the sir is given in the PowerPoint. You can give all the questions and any queries in respect to the topic to this form. We are able to see the queries from various participants.
Okay. Yeah.
Are you there?
Yeah, we can start. Yeah.
Sir, your video is off.
Okay. Yeah, Mohit, we can take up the questions. Yeah.
Yes, sir. Yes. Marjit ji is asking, from accounting point of view, how should differences arising due to selection of safe harbor margin be represented in financial statements?
Very good question, I think. So, from an accounting perspective, reflection doesn't mean anything. It is actually your 15.5% which you are going to recover. Okay, so accounting automatically happens. So, safe harbor is not about accounting, it is about giving you a margin. So, if you have incurred 100, 15.5%, 15.5 CR is to be recovered. That's it. So accounting accordingly flows. But in case you are not in any year, if the margin actually earned is just 13% and you have to account for 2.5 so that you don't disturb the conditions. So that 2.50 additional is to be accounted for as a primary adjustment, and your profit in the books will go up. So only that difference that the accounting is to be done. In normal situation, if it is one person, 15.5, 15, that anyways you are recovering. So no accounting, it automatically comes.
Okay. So Bharatji is asking, sir, whether any changes in tax audit report,
Whether,
whether any changes in tax audit report, maybe the
okay,
question.
yeah. So, Bharat, tax audit, there will be no change. Because if you have followed safe harbor, you are deriving the margins accordingly, and there is no secondary adjustment that you are doing, no additional reporting, except that, of course, in your Form 48 and tax audit in the new format, requires you to mention the adoption of either the arm's length through comparables or through safe harbor. That's the only thing. But if you have a primary or a secondary adjustment, that in any case we are reporting separately. So that needs to be reported. Otherwise, safe harbor is not about change in your policies, practices, or reporting.
Okay. So
And in my
Sarthak,
FAQs, because we were not able to take up, this question is anyways answered. Yeah.
okay. Sarthak Gupta sir is asking, if any assessee does not opt for safe harbor rules through prescribed forms but meet the OPOC margin criteria, then whether it reduces the risk of TP audit scrutiny,
Oh, yeah,
and
yeah.
can it be used as a safeguard in the case of litigation also?
No, if you have not opted for safe harbor, the TPO would still be validating your arm's length, and all those litigation which goes on will continue. And at no point in time you can take the safeguard of a safe harbor, at no level. Because as I mentioned, the first condition is you have to opt for it, if at all the safe harbor is to be applied. So that was condition number one.
Okay. Sir, Sachin Jain is asking, when will be the tax authorities issue the Form 49 for applying the safe harbor rules? Sorry.
No, no. The form is already released. You
Okay.
can apply for it before due date of filing your tax return. And for ITES, because it's a 5-year block, 30th June of the next year, that is June 30th, would be the time for the first year to apply for it. But otherwise, it's always before the due date of your tax audit report.
Sir,
And
Sir
again,
Dilip,
this is covered in my FAQs.
okay. Sir Dilip Gupta sir is asking, as per his understanding, the 15.5% margin of the three tax years, however, the eligibility is for 5 years. What will happen for 2 years for which margin is not given, but the assessee has opted for 5 years, including these 2 years?
Yeah, that as we discussed, you lose the entire benefit of safe harbor and would be subjected to the scrutiny, the litigations in particular, the taxes and penalties for not abiding by. Therefore, throughout my presentation, I have put in a lot of efforts on the transfer pricing benchmark study, transfer pricing diagnostic review, and the benefit metrics. Because if in any year you're not able to meet the margin, say of 15.5%, you lose the approval, and detailed scrutiny, taxes, and penalties will follow.
Okay. Good. These questions, the level of questions the people are asking is the public is listening to all in detail and completely involved with the session. It's a compliment to you and your sessions. Next, Kailash Chandra Sharma ji asking, can we withdraw the APA application and apply for safe harbor rules as it is less time consuming as it against the APA process?
Yeah, there is no defined guidelines. You can always withdraw in case the order is not passed.
Okay. So Nivedita D is asking if an IT company has already opted for safe harbor previously in FY 24-25 for multiple years covering tax year of 26-27 also, which was approved. Should they maintain 15.5 or 17% for tax year 2026-27?
No, 17%. See, it is a fresh application, fresh approval. So if you have the existing approval, then that is to be maintained.
Secondly, would be there any automatic extension of safe harbor for TY 26-27 or would fresh form number 49 need to be filled?
No, the fresh application is to be filed in case your earlier safe harbor tenure is over. There is nothing called automatic, because as I mentioned, it is more a relief. It is not actually a benefit given by the government. It is a relief which is to be opted by you, by the SSC.
Okay, sir. Arvind Tiwari ji asking, what happens if there is a change in business or increase in the revenue threshold in between 5 years block period?
That is where the challenge is. Uh, as we have been repeatedly, including Rajesh sir also mentioned, that you have to have the projections for next 5 years. But if at all this happens, which may still happen, that is okay. Uh, Nothing in writing, but you may still approach the tax authorities that, okay, up to 3 years, this is what the situation is. But now on, maybe we have either shifted our structure, realigned it, and we will not be able to maintain this. So, in the past, we have seen that tax authorities have acknowledged such kind of a request.
Okay.
So, yeah,
Sir,
possible, but
Vikas,
nothing in writing actually.
okay. Sir Vikas Katani ji is asking, can you deep dive more on operating expenses and what all costs are forming part of these operating expenses? Is it more of self-certification or prone to litigation?
So, operating is whatever is incurred on the operations. It what gets excluded is given in the FAQ, but what gets excluded is your, so all expenses are operating expenses except your foreign exchange earnings or expenses, the interest expenses that you have paid, any abnormal expenses which have been incurred during the year, those gets excluded. Otherwise, everything is your operating expense because the expenses are incurred to earn the profits. So, except for the identified 4 points, everything is operating. So, depreciation is included unless it's very abnormal in a year. Any kind of forex gain loss gets excluded. Any kind of interest income expenses get excluded. Any kind of other income, any other non-operational expense gets excluded. Otherwise, the entire P&L is your operating expense.
Okay. Sir, one more question is there. Nivedita ji is asking, could you please enlighten whether a notification FAQ is there which talks about the maintenance of simplified TP documentation while covered under Safe Harbor? This will help eliminate confusion whether full-fledged documentation is required. Full-fledged documentation is required since Rule 1889-6 mentions Section 171 and 172 shall apply.
Correct, correct. So, in the sections, it is mentioned very clearly that TP documentation is to be maintained. What is not to be maintained, which we discussed, is that you still have to give a complete note what you have given while taking the safe harbor approval. That's it. No comparability analysis is required to be done. It is given in the safe harbor approval itself. And you don't have to actually maintain a very complex set of documentation. Okay. But to ensure that the in the next years, the safe harbor is uh, you are following the same practices which you while applying for the approval was there. That's it. This is what you have to do. Otherwise, no complex TP documentation. Even in Form 48, when we are certifying, we will say safe harbor route. Okay.
I have
No
so many
extra.
questions. Actually, I have so many questions pending, and but unfortunately, this will be the last question due to time limitation. Last question for today's session: Form 3CAA non-submission penalty will be initiated during the assessment. or how it will be? Please guide. This will be asked by
So that
Pradarsan Jain.
so no change in penalties in case you're not able to submit the TP documentation in time during the assessment proceedings, or you're not able to comply with the notices or providing the complete information. There is no change in the penal provisions, be it safe harbor, AP, or otherwise. The penalty provisions remain same.
Okay, sir. Thank you very much for this interactive session, and it will be a glad to be part of this session. Uh, as we come to the ends of this highly enriched session, I would like to sincerely thank our distinguished speaker, CA Jay Kumar Tejwani sir, for sharing such a valuable knowledge and practical insight with us today. I would also like to express my gratitude to CA Vishnu Kumar Agarwal ji, CA Satish Ji Gupta sir, chairman of this ICI committee, and IRS Booth sir for their guidance and support. Most importantly, thank you all the participants for your active engagement and thoughtful questions. Your participation truly made this session very interesting and valuable. On the behalf of International Taxation Committee of I once again thank all of you for joining us today. We look forward for the continued participation of our future knowledge sessions. Stay safe, keep learning. Have a wonderful evening. Thank you for your support.
थैंक यू तेजवानी सर, थैंक यू जयंत सर,
Thank you, sir.
बहुत बहुत धन्यवाद. थैंक यू सर.
Thank you. Okay.